to call the Chinese stock market a casino is probably a disservice to casinos. It's there's I think I read in the Financial Times not long ago when it was talking about the looking for the sort of corporate governance and fundamentals of Chinese companies. They said it's still somewhere back in the Qing dynasty. I mean, there is no disclosure. It's a very difficult to understand what is really going on. And the Chinese stock market tends to move on rumors of government support or government crackdowns rather than from anything intrinsic about the companies that compose it. And I think it's very... The stock market goes in waves of boom and bust. It always has done. And now and again, that sentiment gets transferred onto the property market, which has had the same sort of behavior. But I think that there is a view now among Western investors, certainly, that the Chinese stock market, it's had a bounce recently because of a big stimulus package that the company announced, pumping billions to try and revive the property market and the stock market. And that gave it a bit of a bounce in the short term. But I think that most seasoned investors, I mean, there are a few gamblers out there who won't be able to resist the punt, but most seasoned investors, I think, are giving the Chinese market quite a wide berth.
So the ownership of Chinese companies is quite obtuse. You normally do it through ADRs, is it? American Depository Receipts, which are kind of like, so they're
like buying another.
It's like a derivative, right? So you can't buy direct into the company. So they either have to list on markets like the American market, or you buy these ADRs, which are kind of recognized, kind of not.
Yeah, it's not like an IOU, really. I mean, what the classic model, which is used quite by a lot of Chinese companies, is you're actually not buying a share in the company. You're buying a promise to give you various dividends, and this is issued by a company that's typically, say, based in the Cayman Islands, and it's of dubious legality, and essentially it's because a lot of these companies aren't allowed to have the party won't allow them to have foreign owners. So in a sense, you're buying a promise of a share of future dividends, but it's a very again, it's one of those structures which sounded okay in the good days when you never saw any real problems ahead, and it was a way of getting part of the China action without actually owning shares in the company because that wasn't allowed. But
is it another like disguised nuclear bomb that they could set off?
Yes.
They could, like with the electric cars, they turn those off. I mean, we're getting a bit conspiracy here, and I don't want to say that that's going to happen, but the ADRs are certainly something where there's a lot of money sat in the markets. I mean, even a global index fund would be maybe 8% China. I don't know maybe it's less, but there's billions and billions, maybe trillions of Western money invested through these kind of vehicles that they could just go, no, we don't recognize those, and they delete that money in an instant.
Yeah, they could do that. I mean, they have no legal standing.
No.
So it could be withdrawn at any time. I mean, it would do, I think, a lot of damage to the China and Chinese companies. Yeah. So that would suggest that it wouldn't be. But this isn't a share in a company. It's something which is very different.
So when in the past there was companies listed on the American markets, Chinese companies that reached billions in valuation, and when they went and looked, so there was like famous short selling businesses that they basically investigate companies so that they can go, we think this is a load of crap, we're going to short it so we can make money. They went to, say, this company that was listed on, I don't know, the New York Stock Exchange, and when they went to the offices, there was no one there. It was just like a hut. They argued that the business had 5,000 staff. They go and there's nothing. There's like a security guard and an empty lot. And it just come out that at every layer, they'd fabricated the numbers. So because it was like, well, hold on, this business has accounts that have been signed off by the largest accountancy firm in China, like an EY or a Big Four, PwC. So you've just lied. And then it was like, oh, see you later. Do you think that that's a common attitude in China towards the West? And
very, very common. I mean, the accounting standards the American Stock Exchange, when it was so keen to get these companies listed, allowed far lower standards of accounting standards and also other disclosure standards than it was allowing of American companies to be listed, because it wanted these Chinese companies. And it's only now is that beginning to change, and companies are being required to disclose more and to have higher accountancy standards. But I think it's very commonplace.
It's interesting that then they would come to the UK because the UK is desperate for its markets to be bolstered. You don't list in the UK if you want a big valuation. You list in America. Look at ARM and companies like this, that we build these companies and then they go list elsewhere. So for Shen, is it Shen?
Yeah.
To come here, it's almost like they know that we will give them a bit of grace or something.
Yeah, they weren't allowed to list it. Well, they decided not to list in New York because they read the writing on the wall, because there was growing opposition. I mean, not just politically, but also because of the disclosures that would have been required and because of unease about certain practices of the company. And they clearly see the UK as giving them legitimacy as an important market. And they hope where they can find a regulator who is not so strict.
I hope you enjoyed that. It was a clip from our episode with journalist Ian Williams about the economy of China. To watch the full episode, click right here.
What? The economy of China.